And it's my pleasure for that to welcome on stage. First of all, let me start with the lady, Alexandra Lloyd from YouHodler, who will be moderating the panel. Then we'll have Milko Hensel from Merki Baumann, a bank here in Zurich. Next up, we have Paulo Guarniero from Blockstream Capital. We already had Blockstream here on stage, so while your colleagues work downstairs on the workshop. Last but not least, we'll have Alexander Metzger from Swiss Bank. Please welcome and put your hands together for this panel.
Thank you, Bendik. So my name is Alexandra Lloyd, not Baroness Lloyd, as Ilya shouted out earlier. And you might be wondering why the head of AML is here moderating a panel on lending. It is because I have had to explain our lending products multiple times to regulators and lawyers and other compliance teams. So I probably, at this point, know the product better than the guys who built it. But yes, we've been in crypto-backed lending and retail and corporate for a few years, and I have the pleasure of being on a panel here and getting to ask these guys some questions. So if you'll introduce yourself. Paulo first.
Yeah, sure. My name is Paulo Guarnerio. I'm VP Operation at Blockstream Capital Partners Switzerland. Blockstream Capital Partners Switzerland is the financial arm of Blockstream, so we take care of everything that is financial related.
My name is Milko Hensel. I'm team head of our tech banking team at Merki Baumann, one of the first banks in Switzerland that started to enter in the crypto space.
Hi, thank you for having me. Alexander Metzger. I'm with Swiss Bank. Swiss Group basically consists of 3 companies of the bank where I'm sitting. We've been active in custody and trading of digital assets for 3 years. And Swiss Capital, which is our sister company, has been also active on the asset management side, managing fund of funds in crypto.
Okay, great. And I'm going to kick off with the evolution of Lombard. So traditional Lombard loans rely on a bank's internal custody. How does the risk model change when the collateral is held in a multi-sig or a programmable vault shared between a bank and a tech provider? Do you favor internal custody or bringing in tech from custodians who've been operating in the space longer? I mean, what do you think? Paulo, if you want to start off?
Yeah, sure. Well, I think the security of the custody is critical when we're talking about Bitcoin-backed lending. As BCP, we are working with different models. We work both with qualified custodians, including Swiss banks, and more kind of native custodians. But as well, we work with so-called multi-sig technology, where the keys of the multi-sig is spread across different parties. We believe that especially with Bitcoin, multi-sig offer extremely high level of security, and we sometimes prefer this model over others. The question is really how quick, how fast you can be when you have, for whatever reason, to move the collateral. So in case of liquidation, is the custodian be able to operate 24/7? Is the multi-sig and the players that are managing the multi-sig able to sign the transaction at any times of the day or the night? So I think that's really comes as the main risk for us.
Milko, I can see you nodding along there. I take it that you are at least somewhat in agreement with Paulo here.
Sure, especially the last part, being the relevance of speed at the end of the day when it comes to an execution of collateral. That is essentially the critical part in the lending idea. What we see is, however, that we are banks. We would like to keep everything under control. We rather prefer to have the keys with us and act on behalf of our clients, either as a lender, and then we want to execute by ourselves and without any further ado. On the other side, if you're just a custodian, then we also want to make sure that every involved party knows his rights and etc. And we act as a neutral third party between lender and borrower, and then make sure that the assets are moved fast and efficiently, and the more parties involved, the more complex everything gets. And so if you will, of course, technology makes things easier. There's a joint control. Sometimes it's better to transfer control to a third party than we say, okay, if all agree, then we execute.
And Alexander, are we in agreement all here, or do you have a different perspective?
Yeah, of course. As a regulated bank, we opted for a similar custody infrastructure. So in general, we run an internally operated solution where we control the keys of our clients, and we run segregated wallet infrastructure for our clients. And in essence, that's also what our clients are looking for. They're looking for institutional grade custody and regulatory clarity and no counterparty risk, right? But then again, there's some interesting multi-sig solutions out there, which we've been looking at, but they do, there's some risk that needs to be taken into consideration, especially when it comes to liquidation of the collateral. It has to be available to the lender, and in that sense, it's not really. And sometimes it might not be a real multi-sig because somebody has to control the underlying. But yeah, in general, that's our view. Obviously, we do also collaborate with third parties on the lending side, where we plan to act as a custodian, as you mentioned. So there we really act as a neutral custodian, and we don't lend directly.
So obviously, when we're talking about custody and introducing new custody solutions, we're talking about new risks. There's other risks we have to price in. So how do private banks and banks price in that Bitcoin premium compared to traditional equity-backed credit? Is the volatility, are you using higher LTVs? Is it just restricting your asset classes? How are you managing these new risks when it comes to new asset classes?
I can start. I mean, well, I think in the past few years we've seen quite a lot of development in the industry related to lending. We started with only few crypto native offshore company offering Bitcoin-backed lending. Most of the time, these loans, the collateral of these loans were replicated. Most of these players are out of business nowadays. So I think the fact that now we have banks that are entering the space is a very good sign. I think banks are realizing that Bitcoin is a relevant asset class that can be used as a collateral. It's extremely liquid. You can price it 24/7, and it offers high protection from a lender perspective. So we are not still there where I can post my Google stock for 10 million loans. But I believe that in the coming years, where with more banks entering this space, we will be able to kind of find more or less the same level of rates.
Yeah, in general, it is obviously different than traditional asset classes just by the fact that it trades 24/7. So basically, you have to manage your risk differently, and also based on there's a capital requirements that are higher, which needs to also be reflected into the pricing, right? So I'd say that this comes into play when pricing, and then the fact that you have to basically, as a bank, natively you don't have a 24/7 infrastructure, right? So you need to manage that risk by monitoring that portfolio. You can do this internally, but you need the right tools to do so, or you need the right personnel, and this needs also to be reflected in the pricing, right? The other solution, obviously, is to work with third parties that can act as a liquidation provider. So we are basically looking at various options depending on the client needs.
Milko, anything to add, or?
Well, perhaps it makes sense to not just focus that much only on the efficiencies of crypto assets. Yeah, that's definitely a positive point, and that we can execute these things in theory at once, but the problem lies in the details with the people, with being available on Good Friday morning if something happens, and who really takes care of the execution if it's not fully automated, and banks are not fully automated. However, banks are define these risk classes or risk evaluations not barely on their own. So we are dependent also on our regulator. We are dependent on the Bank of International Settlement. We are dependent on the rulings of the Basel Committee. And as long as these ladies and gentlemen that act on this in these organizations and do quite a good job, as long as they do not take in consideration also the technology and the speed of execution, but only volatility and the accessibility of crypto assets, we will not have any adjustment in the risk evaluation from these organizations. Hence, banks can't go in the way they say, look, it's a stable coin, it's pegged to the US dollar. Why should we have 125% of our capital linked into a Lombard loan that actually covers a US dollar cash position? It's covered by a US dollar cash position, sorry. But with blockchain technology, we can't do that. And so I think there is still a learning phase coming from the international institution before we can move ahead in a better place.
You and Alexander both fed quite nicely and psychically into my next question, which was on 3 a.m. automated margin calls. Do we think traditional regulated banks are there yet with that to deal with that friction, or do we think they need a grace period with some humans in the loop?
It depends. I mean, we consider ourselves as a traditional bank. However, we are not UBS, of course, and hence we can move in a more speedy way. So if anything goes wrong and we would be pushed to provide a loan of 10, 20 million, we definitely would make sure that there are people on call to execute this, and you also can put into any stop loss orders. There are ways for individual solutions. However, for a standardized, fully automated thing, we are not there. That's because of our banking systems that are not up to speed, and similar things around that inhibits it so far.
Alexander, since you so nicely set me up for that by speaking about it first, do you have anything to add to Milko's observation there?
No. So I'd say also it is also a bit by design, right? If a client comes to a bank to deposit their Bitcoin and take a loan against it, they're looking also to have some kind of a private bank or personal relationship, right there. If you want to, take a loan versus a smart contract, then you could go to DeFi, right? And having that level of human interaction is also something that our clients are looking for, right? So I'd say that, and then in terms of managing it, well, there's, as you correctly mentioned, like there's a few players that can actually do so. And there's a few ways you can do so. You can manage your risk by having stop losses. You can have a 24/7-hour desk, or you can work with a third-party provider, right? And it's not because you go through a centralized party that it cannot be automated, right? It can, but it's not entirely there with all. Financial institutions.
Paolo, coming from?
I think nothing to add. I think it's all about technology and regulation. Of course, it's a bit problematic, but I'm actually positive that banks are adopting this new technology. I mean, we've seen it in Switzerland. We've seen it also abroad of banks that are adopting a 24/7 model. Maybe just to focus also on the positive side. I mean, the good thing about digital assets is that compared to traditional assets, real estate, or machinery, cars, it's an asset that can be recovered, can be sold immediately, right? If you have like a loan guaranteed by a real estate, and for whatever reason you need to liquidate, the process to recover the loan amount might take several weeks, if not months. So yes, there are some challenges, but there are also some advantage that a lot of players in the traditional finance are realizing and they're taking advantage of.
Yeah, and as these products develop, do you think the goal moves from simple lending to a whole secondary market for the tranches? I know you guys did a project recently.
Yeah. I mean, there were actually few announcements in the last few weeks. Of course, I think that's the directions. I mean, the market is growing, is evolving. We see, especially across like big lenders, the loan book growing significantly, and it makes sense that you can pack this loan book into products, assign it a risk rate, and basically sell it to investors. So I think in the coming years we will see more and more example of institutionalization of digital assets back lending.
I think one of the things that's sort of making adoption a bit slower at the moment, and Alexander, you touched on this earlier, it's for a bank holding Bitcoin on the balance sheet is quite capital intensive under the Basel rules. Does on-chain lending allow for better capital treatment if the asset is non-custodial but contractually locked?
Well, it depends. So first of all, so in general, banks that do offer crypto-backed lending do not take in possession the collateral. So the collateral remains segregated and under the client's name. So it means that it's totally off balance sheets and it doesn't have any capital requirement, right? Where there is some capital requirement is on the loan that the bank might issue on that collateral, because that collateral might not be eligible under Basel, right? So it is, in that sense, not as capital efficient as it should be, because at the end of the day, it's a great collateral. In my view, it's one of the best collateral. Talking about Bitcoin, billions are traded every day. It settles instantly. Obviously, you need the right infrastructure to cater to that, right? In general, I think having some DeFi protocols might be more capital efficient as they don't have those capital requirements. But again, it's a different product, right? When you're taking a loan in DeFi, you're taking all sorts of different risks, be it smart contracts, being Oracle risks as well. So it's different, and I don't think both are mutually exclusive.
Milko, would you consider that banks are favoring one lending model simply because of those capital requirements, or do you think it's just a natural evolution of their risk management?
I mean, I think it depends a little bit on the individual situation of a bank. If it's very capital rich, if it has loads of experience in various kinds of loans and credits, it makes sense for them to delve into this area where they can provide their own capital into that. Whereas if you want to be if you're more on the lean side and say, okay, we want to provide the service to the client, that is of more importance to us than having everything in-house. It makes definitely sense to either at least have a look at decentralized solutions, DeFi lending, or also do away with collateral in-house, but rather rely on third party as a collateral provider, which also exists in traditional finance. It's nothing totally new.
Yeah, so maybe to add, I think like smart contract, it's more a technology that can allow banks to scale up and overcome certain operational limitation, but it shouldn't be seen as a way to kind of find a workaround to the regulatory limitation. And I think that's these limitations are in place to kind of protect investors. And I favor a more kind of approach where the players that are working in the industry are talking with the regulator and find a way to find just better approach that favorable the industry.
And how do you guys see people like asset managers integrating blockchain into their operations level to solve specific problems like the reconciliation or real-time margin call pain points? You have.
We've seen more and more, especially on the administrative side. So asset managers using administrators that are using blockchain infrastructure for reconciliation and for NAV calculations. Some also for rebalancing, but that's for asset managers that are already directly investing in digital assets. It is still early, I'd say, so we see some asset managers that are starting to offer loans and to their clients, but on the traditional side at least, it's still early days.
Same on our side. We try to be as client-driven as possible, and depending on the demand that we see, we evolve our technology. And so far, we see significant demand when it comes to lending, etc. But for instance, for the internal procedures, the processes, and things that can be handled in a traditional way, we stay with the traditional technology. May sound a bit silly because maybe it's to some extent a little bit slower, maybe it takes more arrangements, more effort. On the other side, if you really go to the business case and say, is it worthwhile investing X in order to achieve a faster settlement by 10% or 20%, it often doesn't pay off in the short term. And what we see as a rather small bank is that we can't move the market. If there are markets that exist, that every, for instance, AML check is done on blockchain. If all KYC is linked to a blockchain, then we are happy to follow. We will be the first to implement it. But as long as it doesn't calculate, it doesn't pay off for us, why should we do so? And this is a similar situation with other small banks, I think. They don't want to go too far ahead, and sorry for the fintech companies that we can't support in that way. We would love to, but it has to pay off for us.
Paolo, do you want to add anything, or 30 seconds to answer the last question? Just rogue.
No, I think we are not a bank, so clearly we have different regulatory requirements.
Okay, and so one final question while we've got 20 seconds left. With the crypto collateralized lending market reaching total debt estimated at 73.8 billion as of the end of last year, are stablecoins actually the product of on-chain lending, or are they the medium of exchange? Anyone?
Well, if you look at the settlement of stablecoins last year, they were well over trillions, right? So I would say that it's not only about lending, but cross-border payments as well.
Okay, well, thank you very much for the conversation. I'll be happy to continue it outside. I know we had a few more questions that never got asked.
Thank you.
Thank you very much.